We've all heard of assets versus liabilities, but do you know what the main difference is and why assets are important? So, what is an asset compared to a liability? Assets bring money into your pocket, whereas a liability takes money from your pocket. If we take an example of a house, we know that it's not an asset but a liability, even if you've paid your mortgage in full. But if you rent it out, you will receive an income if the rental is higher than the house's running costs. This will then make your house an asset due to the positive cash flow it brings. It will also be an asset if you sell the home and make a profit. If you want to be rich and financially free, you need to invest your money into assets. You'll never find a rich person who doesn't own many assets, as they make their assets work for them. Examples of assets: investment real estate, businesses, art, dividends from stock and bond investments. Start today by getting more assets, increasing cash flow, and improve your financial situation. Comment below and let us know what you're doing to build up your assets. As per Robert Kiyosaki from Rich Dad Poor Dad, your house and your car are not assets. These get classified as liabilities. You may be asking yourself why. Before we get to answer that question, we need to look at what is a liability. When we hear of assets versus liabilities, we don't realize that a liability is something that takes money out of your pocket. So a car or house is considered a liability, as it costs money to live there or run the car. If we stick to the house example, you can easily say your house is an investment if you've paid it off. But that's not true. You still have to pay for maintenance, insurance, and repair costs. Here are other examples of liabilities: loans, vacations, credit card debt. People who struggle financially will have many liabilities within their budget and will struggle to reach financial freedom. Start with financial education. Learn how to get rid of your liabilities and invest in assets. Holding on to liabilities will only keep you poor for longer. Comment below on what you think are liabilities. We'd love to hear your suggestions. Today's video is about what an investment is and how to invest. Investing is a tool to reach your financial goals on your financial journey. Investment is when you put money away to get a return later in the future. It's a key component of wealth creation. Your investment will grow with compound interest, which means interest grows interest. Popular ways to invest are in stocks, bonds, and real estate. Investing in stocks means you are trusting and believing in a company. If you invest in the stock market and invest in a company like Apple or an index fund that follows S&P 500, your return can be on average 7% a year. By investing in these companies, you will get paid in dividends quarterly, which you can reinvest or keep the cash. Another way to invest is by buying property and renting it out. Rental income can bring wealth if managed correctly. A common misconception is that you need a lot of money to invest, but this is not true. You can invest with whatever amount you have, so don't wait for tomorrow and start investing today. This video is for those that have ever wondered what a stock market is. A stock market is a global marketplace where buyers and sellers meet to exchange cash for shares in companies. A stock market is centralized and regulated for these transactions to take place. There are many stock exchanges worldwide, with the 4 major stock exchanges in New York, London, Tokyo, and Sydney. The price of a share relies on the economic principle of supply and demand, how many people want to buy that stock as opposed to how many people want to sell it. Buyers and sellers will meet in the middle and agree on a price before a transaction takes place. The stock price goes up with demand when there are more buyers of stock than sellers. The price will drop if there are more sellers of the stock than buyers, which can come down to investors losing faith in a company, making the stock unfavorable. You can buy stocks and shares from a publicly traded company on the stock market, and the easiest way to do this is on an online trading platform. gets said that compound interest is the eighth wonder of the world. But what does it mean? Today, we will be looking at what is compound interest. In investment terms, compound interest is interest getting added to the original sum of a deposit or loan, and the interest will compound additionally to an accumulated amount. In simpler terms, it's interest on interest. Compound interest is the result of reinvesting interest instead of having it paid out. It gets based on the initial deposit amount and the interest that's accumulated from previous periods. Here's an example. If you deposit $1,000 into the S&P 500 index fund with an interest rate of 7% annually, compounded annually, you will have $1,070 at the end of the first year. Interest is accumulated over a period, resulting in annual compounding by leaving your money in the account. If you leave the money for a period of 30 years, the interest rate gets applied to the original deposit amount and the interest earned in year one, and so it goes on annually. After 30 years, your original investment of $1,000 would have compounded to $7,612.26. So what are you waiting for? Build wealth with compound interest. In this video, we are talking about dividends, what they are, and how they work. Let's first look at what a dividend is. Dividends are stock-related and are regular payments of a company's profits made to their shareholders. In simpler terms, you invest with them, and they'll give you dividends in return, which are usually paid quarterly in cash. If you don't want the money, you can reinvest the dividends to buy more shares. Dividends are paid depending on the number of shares you own, or DPS, which is dividends per share. Here's an example. A company announces a $1 dividend per share, and you own 100 shares. You will then receive $100. Based on where you live and how you own the share, you'll get taxed on the dividend received. A dividend share is a percent of the current market price and helps compare the dividend sizes. To calculate the dividend yield, you can divide the annual dividend by the stock's price. Dividend aristocrats such as Coca-Cola and Walmart are members of the S&P 500 and have increased their dividend payments annually for 25 successive years. Dividends are great for earning passive income. What is financial intelligence? If you've never heard of financial intelligence, think of financial literacy. Robert Kiyosaki describes it as seeing less with your eyes and using your mind more when investing. Let's look at ways to help you develop your financial intelligence skills. 1. Financial intelligence directs you to see opportunities where others don't. Successful investors will see money in tough times when others don't, and this all comes down to their higher financial intelligence. This especially rings true when we are in a crisis, such as a pandemic. Financial intelligence is investing at the right time and making a profit while others lose their money. 2. Financial intelligence begins with an understanding of money and how it works. Because money is mainly electronic and can't get seen with our eyes, we neglect to see anything. People who are highly financially intelligent can see where money is and grab onto opportunities. 3. Financial intelligence lets you see money. Financial intelligence lets you see money and brings you to opportunities where you can reap benefits. While everyone wonders how you make money, you will continue to train your brain to see money and grab it. Financial literacy brings you to financial opportunities, so build your knowledge and understand the language of money. Please share your own thoughts about financial intelligence. Today, we will learn what an index fund is. Index funds were invented by Jack Bogle, who was also the founder of the Vanguard Group. An index fund is a mutual fund or exchange-traded fund, ETF, that tracks or matches the components of a financial market index. To put it simply, an index fund is a portfolio of stocks or bonds that attempts to replicate the composition and performance of a financial market index. Index funds have lower fees than actively managed funds and are a great passive income strategy. A good example of an index fund is the S&P 500, which has the following returns. Current return, 4.35%. Year-to-date return, 16.03%. 5-year return, 15.75%. 10-year return, 12.53%. The S&P 500 index is a benchmark measure of annual returns that includes around 500 of America's largest publicly traded companies. When investors refer to the market, they are referring to the S&P 500. Another type of index fund to consider is a thematic fund. Thematic funds are a type of index fund with a mandate to invest in one or more specific sectors or themes. Some funds focus on one or two main industries, while others have a broad theme that spans several industries. One of the main advantages of a thematic fund is that higher returns on a focused or concentrated portfolio are possible. Better performance results from lower costs, so choose an index fund if you're looking to add diversity and increase your income portfolio. What are your thoughts on index funds? Do you have the S&P 500 or a thematic fund as part of your investment portfolio? Tell us in the comments section below. We'd love to hear why you have or don't have these funds as part of your portfolio. Today's video is all about what an actively managed fund is. An actively managed investment fund is when a manager or a management team invests the fund's money. Actively managed funds can outperform the market, but often don't, and they usually demand a higher fee. Actively managed funds can be unpredictable, so before investing in one, you must read the fund's history to learn about its past returns. Active management may be worth considering if you're looking for an investment strategy that can outperform the market with the human touch of a fund manager. Active management aims to outperform a certain market index, or in the event of a market downturn, to post losses less severe than those suffered by the index. A fund manager's skill set, skills, experience, and judgments are put to the test when managing money. A fund manager, for example, may have substantial knowledge in the technology sector. As a result, they can potentially outperform benchmark returns by leveraging their knowledge and skills. We'd love to know what type of investor you are. Do you like control and prefer to do everything yourself online? Or do you trust putting your money in the hands of a fund manager to take care of your money and make it grow? Let us know in the comments section below. What is an exchange-traded fund, ETF? When investing your money, you've probably heard about ETFs or exchange-traded funds. In this video, you'll learn all about ETFs and how they can benefit your investment portfolio. So, what is an ETF? ETFs can get bought or sold throughout the day and get traded on the exchange like a stock. Supply and demand in the market will fluctuate the price. Let's take a look at a few characteristics of ETFs. 1. ETFs are like eggs in a basket, but not all eggs are in one basket. Each fund varies with the types of eggs, how many eggs there are, and the basket varieties. ETFs consist of various stocks, shares, and bonds, grouped together and traded as a single unit. 3. ETFs provide you with a diversified portfolio, as they reflect the market as a whole based on their goals and rules. 4. ETFs often follow some index, e.g. S&P 500, which lowers the management costs. 5. ETFs don't always pay out dividends, but if a stock in your ETF does, they can reinvest it back into the fund directly. 6. ETFs are great for beginners, as the fund will take care of your money based on the publicly available rules. Like all investments, ETFs come with risks, so make sure you do your research before you start investing. Please share your own thoughts. What is bad debt? Debt can either be good debt or bad debt. Your credit history relies on how you pay your debt. But you need to know what is considered a bad debt. In this video, we will be explaining what is bad debt. Bad debt gets used to pay for things that lose value over time and take away your net worth. They usually come with high interest rates and cost more than what you can afford over the long run. To put bad debt into simpler words, we can say that bad debt is something you can't afford and can't make money from. Let's look at a few examples of what bad debt is. Credit card debt, personal loans, auto loans, payday loans, loan shark deals. If handled correctly, bad debt can positively impact your financial well-being. But you need to make sure that you never take out a loan you can't afford. Use a budget to ensure you never miss a payment, and you'll be on your way to financial freedom. What is good debt? Debt can be a good thing if it adds value to your life. In this video, we will be explaining what is good debt. When you consider good debt, you need to think about what the debt will be helping you with. Will the debt increase your net worth, or will it become an income-generating tool? If you answered yes to either of these two questions, then you have good debt. Let's look at a few examples of what good debt is. Small business expenses, student loan debt, mortgage loans, and real estate investments. These examples will all add value to your life in the long run. Whether it's to pay for your education to better your career, or invest in your business to promote growth, you are essentially adding value to your life and finances. Good debt positively impacts your credit history, allowing you to buy bigger items, such as a house. Good debt is an investment for your future, so handle your debt correctly and you'll positively impact your financial well-being.
Remember to like and subscribe to my channel, and thank you for watching. I'll see you next time.